Good morning. A major contrarian signal just hit the tape. Here's the plan for Tuesday, November 25th.
All right, let's get right to it. On Friday, we saw a massive inflow, over $1 billion into SPXU. For those of you who don't know, that's a 3x leverage short on the S&P 500. So yeah, that's a pretty extreme bet that the market is about to roll over.
And why does that matter? Well, according to Stocked Up, this is, and I quote, a historically significant contrarian bullish indicator. You know, when sentiment gets this lopsidedly bearish, it's often the fuel for the exact opposite move. Historically, this kind of reading has marked some major market bottoms.
Okay, here's how we're going to break it down today. We'll start with the overnight drivers and news. Then we'll look at volatility in the macro calendar. After that, we'll dive into key sectors and levels. Then, scenarios and posturing, the core bull versus bear thesis, and finally, some actionable trade ideas. Let's get into it.
All right, Section 1. Overnight drivers and top news. Let's set the context for today's session.
So, three things are really driving the tape this morning. First, that contrarian sentiment we mentioned. That billion-dollar bearish inflow into SPXU, well, it was met with the fourth largest volume day ever in bullish leverage ETFs. It's a real battleground. Second, we're seeing some positive chatter on the US-China front, specifically a potential reversal of the NVIDIA AI chip sale ban. That's a huge potential catalyst. And third, geopolitical risk seems to be coming off the table, with reports of momentum in Ukraine-Russia peace talks and Saudi Arabia showing interest in the Abraham Accords.
Moving on to Section 2, volatility and the macro calendar. Gauging risk is absolutely critical right now, especially heading into a low-volume holiday week.
So look at this. The market is now pricing in an 83% chance of a Fed rate cut in December. Just last week, that number was sitting at 41%. That's a massive shift, and this dovish pivot is really the main tailwind for equities at the moment.
And on the volatility front, the VIX is telling a story. Remember that spike to 28 last week? It completely failed to hold. It got smacked back down, closing yesterday around 20.5. You know, that failure to sustain fear? That's a classic sign of transient panic, pretty typical for what we see ahead of a holiday week where liquidity dries up.
All right, let's get into the guts of the market. Section 3, key sectors and levels. Because when you look under the surface, you see some really significant divergence.
The so-called Magnificent Seven are not moving in lockstep at all. In fact, they're all over the place. You've got your leaders, Geogles and APL, in confirmed uptrends. Then you have MSFT and AMZN, which are testing that critical 200-day moving average support. NVADA's in a pullback stuck below its 50-day, and then you have the laggards, Meta and NFLs, which are in confirmed downtrends. This kind of divergence is a major red flag for market breadth.
So, what does this all mean for the S&P 500? Well, it all comes down to this inflection zone. We've got support right around 6,550 and resistance up near 6,800. Honestly, how the market resolves this range is probably going to dictate the entire direction into year-end. Okay, quick but important disclaimer. This is all for educational purposes. We're just aggregating public info to help you stay informed and sharpen your own decision-making. So please, do your own research. This is not financial advice.
And hey, if this is helping you get prepared for the day, do me a favor and subscribe. Turn on those notifications for the new weekly market update playlist so you don't miss any of our future recaps.
Okay, Section 4 is where we put it all together. Market scenarios and posturing. Let's define the actual game plan for today. So here are the triggers. The bull trigger is simple. SPY has to hold above that 6,550 support. A decisive reclaim of 6,800 on real volume would be the confirmation. On the flip side, the bear trigger activates if SPY fails at 6,800 and then breaks that 6,550 support again on volume. The levels are very clear.
So what's the base case? For a low-volume holiday week like this, we're expecting choppy, sideways consolidation, basically bouncing between 6,550 and 6,800. The posture here should be neutral and de-risked. That means a higher cash allocation. Don't be a hero until one of those triggers we just talked about is confirmed. Declining volume within this range will tell us we're right.
Next up, Section 5. Let's really dig into the core thesis here. The bull argument versus the bear argument. What are the competing narratives?
All right, the core conflict. The bull thesis is pretty straightforward. That extreme bearish sentiment from the SPXU flows provides the perfect fuel for a short squeeze. And you've got major tailwinds from a dovish Fed and geopolitical de-escalation. But the bear thesis says not so fast. The rally has clearly stalled, market breadth is weakening, just look at that Mag 7 divergence. And that dovish Fed pivot? It might be priced to perfection, creating some serious asymmetric risk to the downside if anything goes wrong.
Okay, last section, Section 6, Actionable Trade Ideas. And just to be clear, these are potential strategies for this environment, purely for educational purposes.
Okay, a few sample strategies. First, for NVDA and that China policy news, that's a binary event. A debit strangle could be one way to play it, trying to capture a big move either way. Second, we've seen some unusual call flow in Pfizer, hinting at a healthcare rotation. A bull call spread could be a defined risk wave to get some bullish exposure there. And third, for the SPY and that range-bound holiday chop we're expecting, an iron condor could be structured to profit as long as the market stays between that 6550 and 6800 range.
And of course, the required warning here. Options involve substantial risk. Your capital is at risk, and yes, losses can exceed the premium you paid. So be smart, size your positions correctly, and manage your stops with discipline.
Hey, if this analysis helped you get your plan together, a quick like and subscribe would be great. Make sure you turn on alerts for the next morning brief.
So I'll leave you with this question to think about as you head into the session. We're at a clear technical inflection point, and holiday liquidity is draining out of the market. So, is this a time for aggressive positioning, or is it a time for capital preservation?
And one last time, the final disclaimer. This is not trading advice. It's a market update to keep you informed. All markets carry risk, so trade your plan, manage your downside, and always verify all your data. Good luck out there.